Hello everyone, welcome back. Do you know how to turn an economic crisis into the biggest opportunity of your life?
How to survive an economic recession and make huge profits.
Welcome, resilient investors and forward-thinking entrepreneurs. Today we are dedicated to navigating the tumultuous waters of economic uncertainty and seizing opportunities for financial success. I'm delighted to be your guide on this insightful journey, and now we'll explore strategies for not only surviving an economic recession, but also thriving and making substantial profits in the process. Join me as we uncover actionable tips and insights to help you weather the storm and emerge stronger and more prosperous than ever before. Economic recessions can be challenging times for individuals and businesses alike, characterized by widespread uncertainty, market volatility, and financial instability. However, history has shown that recessions also present unique opportunities for savvy investors and entrepreneurs to capitalize on market inefficiencies, acquire undervalued assets, and position themselves for long-term success.
The first 100,000 is a bit... I don't care what you have to do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100,000.
Let's explore some practical strategies for not only surviving an economic recession, but also making huge profits. 1. Diversify your investment portfolio. During times of economic uncertainty, it's essential to diversify your investment portfolio to mitigate risk and protect your wealth.
Okay, but what does a diversified stock portfolio look like?
A well-diversified stock portfolio is crucial for managing risk while capturing growth from various sectors. In this example, 30% of the portfolio is allocated to technology, reflecting the dominant role of companies like Apple and Microsoft in the global economy. 15% is placed in consumer discretionary stocks, including Amazon and Home Depot, which benefit from consumer spending. Financials, making up 15%, include giants like JP Morgan Chase and Goldman Sachs, offering stability and consistent dividends. Healthcare, energy, and consumer staples each account for 10%, providing a mix of growth and defensive stocks. Companies like Johnson & Johnson in healthcare, ExxonMobil in energy, and Coca-Cola in consumer staples ensure the portfolio is balanced across economic cycles. Industrials and communication services round out the portfolio, making it resilient against market volatility, while offering opportunities for growth in key sectors. And we could also take a look at the portfolio of the world's greatest investor, Warren Buffett's investment strategy. As reflected in Berkshire Hathaway's portfolio, is highly concentrated, but focuses on high-quality businesses with durable competitive advantages. Nearly 25% of the portfolio is invested in Apple, signaling Buffett's strong belief in the company's long-term prospects. Financials also play a significant role, with 10% in Bank of America and 7% in American Express. Buffett has long favored consumer staples, as seen in his 8% stake in Coca-Cola and 4% in Kraft Heinz, reflecting his preference for companies with strong brands and consistent cash flow. Energy stocks like Chevron and Occidental Petroleum represent 11% of the portfolio, showing Buffett's belief in the value of oil companies, especially in times of rising demand. Despite the concentration in fewer stocks, Buffett's portfolio is designed for long-term growth and stability, sticking to the principles of value investing. Spread your investments across different asset classes such as stocks, bonds, real estate, and commodities to minimize exposure to any single market or sector. Example, Sarah, a prudent investor, diversifies her investment portfolio by allocating her assets across a mix of stocks, bonds, and real estate investment trusts, REITs. By diversifying her holdings, she's able to reduce the impact of market volatility and preserve her wealth during economic downturns. 2. Focus on quality investments. In uncertain economic times, prioritize quality investments with strong fundamentals, stable cash flows, and resilient business models. Look for companies with a history of consistent earnings growth, low debt levels, and competitive advantages in their respective industries. Example, John, an astute investor, focuses on investing in blue-chip stocks of companies with strong balance sheets, sustainable dividends, and proven track records of profitability. By focusing on quality investments, he's...
But wait a second. How can I identify a blue chip stock?
Blue-chip stocks are shares of large, well-established, and financially stable companies that have a strong and reliable performance track record over time. These companies are typically leaders in their industries, have a reputation for quality, and are known for consistently paying dividends to their shareholders. Some common characteristics of blue-chip stocks include high market capitalization, large market value, financial stability even during economic uncertainty, a history of steady growth and performance. Typically, they pay regular dividends. Common examples of blue-chip stocks include companies like Apple, Microsoft, Coca-Cola, and Johnson & Johnson. They are seen as safer, long-term investments, although they also have less potential for explosive growth compared to shares of smaller or emerging companies. He's able to weather market downturns and capitalize on opportunities for long-term growth. 3. Seek out undervalued assets. Economic recessions often create opportunities to acquire undervalued assets at bargain prices. Look for opportunities to buy stocks, real estate, or businesses that are trading below their intrinsic value due to temporary market dislocations or investor pessimism.
And how can I find undervalued assets in the stock market?
Finding undervalued assets in the stock market involves identifying stocks that are trading below their intrinsic value. Here are some key strategies to help you spot undervalued stocks. 1. Price to earnings ratio, PE ratio. Compare a company's PE ratio to that of its industry or the overall market. A lower PE ratio might indicate that the stock is undervalued, especially if the company has strong fundamentals. 2. Price to book ratio, PB ratio. This compares a company's market value to its book value. A PB ratio below 1 could suggest that a stock is undervalued. 3. Free cash flow, FCF. Companies with strong free cash flow, cash left after capital expenditures, but a low stock price may be undervalued. High free cash flow means the company generates good income, even if the stock price doesn't reflect it. A high dividend yield compared to industry peers might indicate undervaluation, as it could mean that the stock price is lower than expected for a company paying such dividends. 5. Debt levels. Companies with low debt and a good balance sheet may be undervalued, particularly if the market hasn't fully recognized their financial stability. 6th, earnings growth. Look for companies with solid historical earnings growth, but whose stock price has lagged behind. This could be a sign the stock is undervalued. 7. Look for market overreactions. Sometimes stocks become undervalued due to overreactions to short-term news or broader market trends. A company with strong long-term prospects but a temporary drop in price could be a good opportunity. 8. Use discounted cash flow, DCF. Analysis. This method estimates the intrinsic value of a company based on its expected future cash flows. If the DCF value is higher than the current stock price, it might suggest undervaluation. By combining these methods, you can identify potential undervalued assets in the stock market. However, it's important to do thorough research and consider the risks involved in investing. Example, Maria, an opportunistic investor, identifies undervalued stocks of companies with strong fundamentals and growth prospects that have been unjustly punished by the market during a recession. By buying these stocks at discounted prices, she's able to capitalize on their future potential and generate significant returns. 4. Adopt a contrarian mindset. During economic recessions, it's important to adopt a contrarian mindset and resist the herd mentality of panic selling and short-term thinking. Instead of following the crowd, seek out opportunities that others may overlook and be prepared to go against the grain for long-term success.
So how can I adopt a contrarian mindset?
Adopting a contrarian mindset in the stock market involves thinking and acting differently from the majority of investors. Here are some steps to help you develop this approach. 1. Understand market sentiment. Contrarians pay attention to overall market sentiment and investor behavior. When the majority is overly optimistic or pessimistic, contrarians see potential opportunities. Second, popular opinion. Avoid following the crowd blindly. If everyone is buying a certain stock, consider why and whether the stock might be overvalued. Similarly, if a stock is being heavily sold off, evaluate whether the negative sentiment is justified. 3. Look for market overreactions. Markets often overreact to news, whether good or bad. A contrarian investor seeks out opportunities in stocks that have been sold off due to temporary setbacks or irrational fears. 4. Focus on long-term value. A contrarian mindset emphasizes long-term value over short-term trends. Find companies with strong fundamentals that might be undervalued due to temporary market conditions. 5. Embrace patience. Contrarian investing requires patience and discipline. You may need to wait for the market to recognize the true value of an asset, which can take time. 6. Control emotions. Avoid letting emotions such as fear or greed drive your decisions. Contrarian investors stay calm during market highs and lows, basing their actions on analysis, not emotions. 7. Use fundamental analysis. Dive deep into the financials of a company to assess its intrinsic value. A contrarian investor often looks for assets that are fundamentally strong but overlooked or undervalued by the market. By thinking independently and avoiding herd mentality, you can adopt a contrarian mindset and potentially find opportunities others might overlook. Example, Tom, a contrarian investor, takes advantage of market pessimism during a recession to buy shares of high-quality companies at discounted prices. By maintaining a long-term perspective and ignoring short-term market fluctuations, he's able to profit from the eventual recovery and growth of these companies. 5. Explore alternative income streams. In addition to traditional investments, consider exploring alternative income streams such as rental properties, online businesses, or freelance work to generate additional cash flow during an economic recession. Diversifying your sources of income can provide stability and resilience in uncertain times.
And how can I find alternative income streams?
To find alternative income streams outside of the stock market, consider these options. 1. Real estate rentals. Renting out residential or commercial properties can provide a steady stream of passive income. You can also consider short-term rentals through platforms like Airbnb. 2. Create and sell digital products. Develop ebooks, online courses, or templates, and sell them on platforms like Etsy, Udemy, or Amazon. Once created, they can generate ongoing passive income. 3. Freelancing or consulting. Offer your skills or expertise on a freelance basis. Platforms like Upwork or Fiverr allow you to find clients, or you can consult in areas where you have specialized knowledge. 4th, peer-to-peer lending. Use platforms like Lending Club or Prosper to lend money to individuals or businesses, earning interest on your investment. This can be a way to generate passive income without the stock market. 5. Start a small business. Whether it's selling products, offering services, or creating a side hustle, starting your own business can open new income streams. This could be an online business, local service, or something you're passionate about. 6. Create a YouTube channel or podcast. By building an audience and creating valuable content, you can earn money through advertising, sponsorships, and donations on platforms like YouTube or Patreon. 7. Affiliate marketing. Promote products or services from other companies and earn a commission for every sale made through your referral. This works well if you have a blog, website, or social media presence. 8. Rent out assets. If you have a car, tools, or equipment, you can rent them out through platforms like Turo for vehicles or Fat Llama for equipment. 9. Teach or tutor. Offer private tutoring, lessons, or workshops either online or in person. Teaching something you are skilled at can be a consistent source of income. 10. Sell handcrafted products. If you are crafty, you can make and sell items like jewelry, home decor, or art through online marketplaces like Etsy or at local markets. These income streams allow you to diversify your earnings. Example, Lisa, a resourceful entrepreneur, starts an online e-commerce business selling handmade products to supplement her income during an economic recession. By tapping into the growing demand for online shopping, she's able to generate additional revenue streams and protect herself against economic downturns. 6. Remain disciplined and patient. Finally, it's crucial to remain disciplined and patient during an economic recession, avoiding impulsive decisions driven by fear or uncertainty. Stick to your investment strategy, maintain a long-term perspective, and be prepared to weather short-term volatility for the opportunity to reap substantial profits in the future.
So, how can I maintain a long-term perspective and endure short-term market volatility?
To maintain a long-term perspective and endure short-term market volatility, consider the following strategies. 1. Focus on long-term goals. Remind yourself of your investment objectives, such as retirement or wealth accumulation, which often take years or decades to achieve. 2. Diversification. Spreading investments across various asset classes, stocks, bonds, real estate, reduces risk and helps cushion the impact of short-term market swings. 3. Avoid emotional decisions. Reacting impulsively to market volatility can harm your portfolio. Stay calm and avoid making hasty moves based on short-term market fluctuations. 4. Rebalance periodically. Regularly review and adjust your portfolio to ensure it aligns with your risk tolerance and long-term goals. 5. Keep investing consistently. By practicing dollar-cost averaging, investing a fixed amount regularly, you reduce the impact of market timing and potentially buy more shares when prices are low. By focusing on the bigger picture, you'll be better equipped to handle the ups and downs of the market. Example, David, a disciplined investor, stays the course during an economic recession, resisting the temptation to panic sell or deviate from his long-term investment plan. By remaining patient and disciplined, he's able to capitalize on market opportunities and achieve significant returns when conditions improve. While economic recessions can be challenging and uncertain times, they also present unique opportunities for savvy investors and entrepreneurs to thrive and make huge profits. By diversifying your investment portfolio, focusing on quality investments, seeking out undervalued assets, adopting a contrarian mindset, exploring alternative income streams, and remaining disciplined and patient, you can navigate the stormy seas of economic uncertainty and emerge stronger and more prosperous than ever before. Now that you know how to survive a financial recession, would you like to know how to become a millionaire? Click here to continue learning and mastering the art of finance.